folks, hope you're all well. A quick little video tonight at the request of one of our Discord members who had a question on dollar cost averaging, but what I think they were actually asking about is laddering or scaling into and out of trade positions. So I thought I'd do a little overview video just to try and help rather than write a lot of text in Discord. I wrote an article fairly recently that contains some of this, which you can find on my website if interested, titled The Pitfalls of a Beginner Marketeer. We'll just go a little bit kind of deeper into some of the stuff that I said in this video tonight. So first up, I want to define what I consider to be DCA or dollar cost averaging, which is very much the traditional description of the process and is very similar, if not identical, to the Investopedia article that I've put on screen there. So to me, DCA is the act of putting the same amount of money into the market at the same interval every week or month without even looking at a chart. There's no chart involved in it. My background is in traditional markets, and that's where I draw this definition from. Generally, it's not used for buying single assets and placing all your money on that asset. It's more for a portfolio or a basket of assets, either something that somebody's built themselves to suit their target diversification, or by investing into either index trackers or more popularly ETFs, which are a basket of assets that are essentially managed for you, either tracking an index automatically or by a fund manager. Think along the lines of pensions if you're UK based, and investment or stocks and shares ISAs, where every month an amount goes in and buys however much of the basket that you've got at that point in time, helping to smooth out volatility over time, regardless of a chart. And that's very much what DCA, or the classic definition of DCA, is intended for. It's helping to smooth out volatility over time for casual investors who have a long-term time outlook. And it's been shown from that investing perspective that this approach generally does well, returning positive outcomes over time if your outlook is long enough, and if you don't have a fixed date for recovery of the funds, depending on market conditions at around any kind of date you've got in your head. Now, there are more advanced ways to DCA and different ways to DCA, so that there may be people using mathematical formula to identify the best times to put the same amounts of money into the basket of assets, or some people will be using seasonality to only put money in during certain times of the year where stocks are generally lower than the rest of the year. So May is a time, for example, that equities tends to have a bit of a rundown, so people will potentially look to invest in May, or quarterly investing or weekly, etc. I think that the key is that it's just there's a methodology behind it, and it just involves putting the same amount in during these periods to a collection of diversified assets in a basket within a portfolio, and not looking at a chart at all. In trading circles though, and particularly in crypto, I find the term has been somewhat stolen and has been used essentially by traders as an exchangeable term for laddering or scaling into and out of positions, and the two are very different things. And I'll be quite blunt on it. It's my opinion that if you're looking at a chart at all, then you're not using DCA in the classic sense. Using a chart in order to utilise technical analysis to base your decisions on is not DCA. It's very much scaling or laddering into positions. And I won't get into it here, but buy the dip and hodl, for example, is not a DCA strategy. It's an exit liquidity scam, but that's for a different video. So what's the distinction then? So if you're basing your decisions on price action on a chart, as I said, and you're looking for areas to scale in and out of positions based on those technicals, what you're actually doing there is just that. You're scaling or laddering into a trade position rather than dollar cost average investing. It takes a lot more involvement. It's a trade after all, rather than a long-term fire and forget DCA investment. It's going to take ongoing management of that trade, and critically, I think something a lot of people miss out on is it's going to take risk management in order to protect your capital. So let's get into the crux of the question that was asked in the Discord earlier. And what was trying to explain there in writing, and not particularly well in writing, I don't think, is that if you're using scaling or laddering to get into positions, then you don't need to always use that in one direction. And what I mean by that is, if you look at this chart, Now, I'm not suggesting that this area was an area where dollar cost averaging could have been used. I've done nothing else on this chart other than try and find a low that I could make this point with. So this is not me rewriting history when it comes to the COVID dump. It's just a decent example that I can give of it. So when I say people tend to utilise it or think of it as a one-way thing, they'll very much layer or scale their orders in this method where, they pick a low. So I've got this low on the left hand side here where people are saying if it comes and dips or it's unlikely to come and dip below that, so that's going to be a bottom, it's coming down there for a double bottom or a triple bottom, so I'll take my first scale in above it, my second scale in on it, and I'll take a third scale in below it just in case it wicks down. And they place the limit orders in that order, 1, 2, 3, and it might be the same percentage on every order, or it might be scaling up or down in terms of the highest amount at the top, then a mid amount, and then a smaller amount at the bottom, or vice versa. People do it in different methods, but the point I'm trying to make is that they tend to do it in that order, where it's a limit order 1, limit order 2, limit order 3, and if all of those catch, then the average in this scenario, the average is 2. That's why I put 3 in there just to make it easy to do the maths. But the average is 2, and they move on. What that does essentially, though, and again, this is just my opinion of it, what that does essentially is it leaves you trying to pick bottoms, because you're scaling on all the capital you've got in that trade to that area where you think it's going to go. Now, there are scenarios where it might not come that low and it might run away without you. To my mind, that's absolutely fine, because ultimately we're risk managers, and if the trade's gone without you, your risk is 0, job done, move on. There's always going to be another trade, another place to get in, so you don't need to worry about the positions that you miss, because ultimately you've managed your risk. But if you do catch all of these and price keeps going further like it did here, you can see there's a bit of pain there that people will have to kind of suck up, and it can make people uncomfortable. And that was the kind of question that came around, is how do you know it's going to be the bottom? And the answer is you don't. You never do. Nobody can pick bottoms consistently. It's just not possible. Whoever comes up with a way of doing that is going to be a very, very, very rich person. So we never assume that we've got that ability. And your only options there, if you're taking this top-down approach to scaling in, is to either ride that, like most people will do, because again, they conflate dollar cost averaging, which traditionally doesn't involve stop loss or risk management, with scaling into position. And in a position like this, when you're scaling in, you should have a stop loss in this, and this should have theoretically hit your stop before it bottomed in this scenario, to give you the capital back and limit your losses. But people tend not to use stop losses when they're using DCA or what they think is DCA, but actually scaling or laddering in this scenario. So the point I was trying to make is this is the aggressive way of laddering into a position, and there's nothing technically wrong with it if you're happy with the risk and you can control the risk and you have a stop in and manage your stop. But if it worries you in terms of trying to figure out where that bottom is and how to scale in, then if you look on the right hand side at how much price then spent within your DCA zone after it bottomed well below where you were having to hold on to a bag that was down, essentially, you had plenty of time there to actually scale into position on the way up in reverse order. And this happens often. It's one of these oddities where pretty much every study that's ever been done on trading data, particularly on retail trading data, the one thing that the 80% who tend to fail and leave the industry have in common is they're all more likely, or they can evidence in the data that they all add quite happily to losing positions, because in their mind they're dollar cost averaging their position down, and they now need to see it bounce less to break even. So they're far more likely to add to losing positions than they are to add to winning positions when the market's already shown its hand that it's going in their favour. And it's quite an interesting statistic. That it was certainly interesting when I read it. I think I read it in a book recently. I'll try and find the quote and stick it in Discord. But it's that I'm talking about. So rather than ladder in while price is on the way down, if that makes you uncomfortable, there's absolutely nothing wrong with setting your ladders in the opposite direction, so somewhere like that. So it's still the same zone, you're still going to get the same average price in this scenario, but you're getting it on the way up as it's bouncing. So you see it take out this high, you're comfortable, you can get in here again on the low. You see it take out the high, you can get in on the low. You see it take the high, you can get in again after the low, and then price is on your side, it's in your favour. You're adding then to a winning position rather than gambling on catching the bottom in what could potentially become a losing position. And the beauty of this method from a risk management perspective is when you take your first ladder here at this low, your stop can be relatively tight in this scenario because price has already shown you it's recovering, it's on that side, and if it blows through it, you've only lost the one ladder or the one scale. You've still got your capital that you had set aside for 2 and 3. You've taken a smaller loss as it goes, and then it's up to you to decide, do I think it's going to go after that, or is it going down further at this point in time, and will I scale back in on the way up? But when in this scenario, when it doesn't take out your stop, as soon as you ladder in to your second position, the stop for your second position isn't the same as the stop for your first position on the way up, because you're now taking the bounces. So structurally, you might have had your stop below this, let's say below this low, just for argument's sake. It's maybe not the best place, but just for argument's sake. And then when you take this second partial, you can move that initial stop up to there, so you've now limited your stop for that one. When it keeps going and you take your third partial further up, you might look at that and say, well, actually the stop location is here, so now you can move your stop for position 1 and position 2 to the same place as the stop for position 3, which is here. This leaves you with position 1 already in profit, so you've de-risked that portion of it completely. Position 2 is at break even now, so you can't lose anything on position 2. The only portion of your trade that you can lose money on is the one that's at position 3, because you've scaled into winning positions on the way up, rather than trying to catch the bottom and scaling into what could become a losing position on the way down. So as I say, there's nothing wrong with either from a scaling perspective, and there are plenty of successful traders who will scale positions on the way down. I would say one thing that they will absolutely do is have risk management in place and have stops to control that, so that if they go too low below the ladder, they can get out with the capital and then look to get in down here somewhere. And that's an option I'm not going to talk about just now, but that obviously is an option for you. If you were 1, 2, 3 and it comes down here, you could decide, I'm going to go in here because it's definitely going to go. That takes a bit more nerve, and if this makes you nervous, getting in here is probably going to make you nervous. So this is maybe a better approach for you. And that's the general kind of principle of it. It makes it easier for you to control your risk on the scaled positions or the ladders on the way up, and it means you can de-risk the trade far quicker, because you can de-risk portions of it as you add the next portion. Because if you're saying that your stop for scale 3 is here, you're not going to leave your stop for 2 here and your stop for 1 there if you think the actual location of the stop is it. You're going to move them all up, so now you've got a couple of positions in profit or break even, and you're golden as it moves up. So that was the general kind of point I was trying to make this afternoon in terms of the aggressive scaling and the conservative scaling. And if the aggressive scaling makes you lose sleep, the conservative scaling is maybe something that you could look at, play around with the maths, go back into your charts and have a look at where you might have done that, how you might move your stops and trail your stops after that, and how you might manage the position when you're in trade. And that again goes back to the first point I made, where what we're talking about here is not fire and forget DCA where you can just buy somewhere and leave it. If that's what you want, you're better just putting money in traditional DCA on a monthly basis to a basket of assets and hoping that grows over time. If you want to be in trade position, which this is, and scale into trade position like this is, then there has to be a minimal level of management in that position and capital management in that position, so that you can protect yourself for the longer term. So hopefully that makes sense. If you have got any follow-up questions, stick them in the Discord. Happy to answer, but hopefully the visual made a bit more sense than the nonsense words I was talking earlier. Cheers.